$40,000 gone in one tax year. And most retired Americans have no idea this is happening to them right now, inside their own retirement accounts. If you are retired or getting close to retirement and you have a spouse, I need you to stop what you are doing and watch this entire video. Because the moment you die, the IRS changes the rules on your spouse, immediately, without warning, and without mercy. The income does not go down by much, but the taxes go up dramatically. Your spouse could owe thousands of dollars more every single year just because you are gone. This is not a glitch. This is not a mistake. This is the law, and it is working exactly the way the IRS designed it to work. The good news is there is one document, one specific filing decision that can prevent most of this damage, but you have to set it up before it is too late. Here is what the IRS can legally do to your surviving spouse. First, the IRS can move your spouse into a higher tax bracket automatically. Right now, if you are married filing jointly, you enjoy some of the widest tax brackets in the entire federal tax code. The moment you die, your spouse loses that status. They become a single filer. The single filer bracket is much narrower. The same amount of income that was taxed at 12% can now be taxed at 22%. That is not a typo. That is the law. Second, the IRS can trigger what is called IRMA, the Income-Related Monthly Adjustment Amount. That is a surcharge on Medicare Part B and Part D premiums. It is calculated using your income from 2 years ago. If your combined income was above $85,000, your spouse will now be measured against the single filer threshold, which starts at $85,000 for one person. So the same household income that caused no surcharge before can now cost your spouse an extra $1,000 or more per year in Medicare premiums alone. This is calculated using your tax return, specifically the income figure on line 11 of Form 1040. Third, the IRS can legally reduce the standard deduction your spouse receives. Married filing jointly gives you a standard deduction of roughly $30,000 in recent years. As a single filer, that drops to roughly $15,000. That means $15,000 more dollars of income is now exposed to federal tax every year for the rest of your spouse's life. Most people do not know this because nobody is paid to tell you. Your financial advisor gets paid to sell you investments. Your insurance agent gets paid to sell you policies. And most tax preparers are focused on last year's return, not on a strategy that protects your spouse 10 years from now. This information lives in the tax code. It lives in IRS publications that most people will never read, and it is perfectly legal for no one to ever bring it up to you. This is what I call the widow's tax. Some financial experts call it the widow's penalty, but whatever you call it, the result is the same. Your surviving spouse earns almost the same income, but they pay dramatically more in taxes. Here is a real-world example. Suppose you and your spouse receive a combined $12,000 per month in income. That includes Social Security, required minimum distributions from an IRA, and maybe a small pension. Together, you file as married filing jointly. You pay federal income tax at the 12% rate on most of that income. Then you die. Your spouse now receives $9,000 per month. Income dropped. But their filing status also changed. They are now a single filer. That $9,000 per month puts them in the 22% bracket. Their tax bill goes up by thousands of dollars per year, even though they are living on less money. This is not speculation, this is arithmetic, and it happens to millions of American households every single year. The reason this feels like forbidden knowledge is because fixing it requires planning years in advance. By the time your spouse is sitting at the kitchen table alone, it is often too late to undo the damage. The window has closed, the accounts are set, and the IRS is collecting. The first thing you need to understand is the Roth conversion strategy. This is the most powerful tool available to retirees who want to protect a surviving spouse from the widow's tax. Here's how it works. A traditional IRA or a traditional 401k contains pre-tax money. Every dollar inside that account has never been taxed. When your spouse inherits that account and takes distributions, every dollar is taxed as ordinary income, as a single filer, at the higher single filer rate. A Roth IRA is completely different. The money inside a Roth has already been taxed. Qualified distributions from a Roth are tax-free, not tax-deferred, tax-free. So here is what actually happens when you convert a traditional IRA to a Roth. You pay the tax now, while you are still alive, while you are still filing as married filing jointly, and while your tax bracket is as wide as it will ever be. Then your spouse inherits a Roth IRA. They take distributions, and they pay zero federal income tax on that money. Here is the concrete dollar example. Suppose you have $200,000 in a traditional IRA. If your spouse inherits that as a traditional IRA and withdraws $10,000 per year, they will owe roughly $2,200 in federal tax on each withdrawal at the 22% rate. Over 10 years, that is $22,000 in taxes. But if you convert that IRA to a Roth before you die, and you pay the conversion tax while filing jointly at the 12% rate, you might pay $24,000 in total conversion taxes spread over several years, and your spouse pays nothing on withdrawals. The math depends on your specific situation, but for many couples, the conversion saves tens of thousands of dollars. What you should do right now is pull out your last Form 1040 and look at line 15. That is your taxable income. Find out how much room you have left in the 12% bracket. Every dollar you convert up to the top of that bracket saves your spouse from paying 22% or more on the same money later. The second thing you need to understand is the Social Security taxation trap, and this one surprises almost everyone. Up to 85% of your Social Security benefit can be taxed. Most people know that. But here's what most people never think about. The threshold for taxation is different for a married couple versus a single filer. If you and your spouse are married, the combined income threshold where Social Security becomes taxable starts at $32,000. As a single filer, that threshold drops to $25,000. Here's what that means in practice. Suppose your spouse receives $18,000 per year in Social Security after you are gone. They also receive $12,000 in IRA distributions. Their combined income for Social Security purposes, called provisional income, is $24,000. That is below the single filer threshold. So their Social Security is not taxed at all. But now suppose they receive the same Social Security payment and they take $20,000 from the IRA. Their provisional income is $28,000. Now 85% of their Social Security is taxable. That is $15,300 in previously untaxed income that is suddenly exposed. At the 22% tax rate, that is an extra $3,360 owed to the IRS per year, just because the IRA distribution went up by $8,000. This is the hidden multiplier effect. $1 of IRA distribution can cause multiple dollars of Social Security to become taxable. This is why the size of your traditional IRA matters so much for your surviving spouse. The bigger the IRA, the more distributions they are forced to take. And every dollar of forced distribution pushes more Social Security into taxable territory. The action step here is this. Look at the required minimum distribution rules under IRS Publication 590-B. Your spouse will be required to take distributions from an inherited traditional IRA every year. Those distributions are not optional. They are legally required. Knowing those amounts in advance lets you plan the Roth conversion strategy from Act 1 to reduce the damage before it starts. The third thing you need to understand is the inherited IRA 10-year rule. This changed dramatically in 2020, and millions of American families do not understand the new law. Before 2020, a surviving spouse who inherited an IRA could stretch distributions over their own life expectancy. They could take small amounts each year and pay small amounts of tax. This changed with the Secure Act. For most non-spouse beneficiaries, meaning your adult children, the account must be fully distributed within 10 years. But here is what most people never realize. A surviving spouse still has special options. Your spouse is not subject to the 10-year rule. They can roll the inherited IRA into their own IRA. They can treat it as their own account. They can delay required minimum distributions based on their own age, and they can name new beneficiaries of their own choosing. This is a legally significant protection, but it only works if the account is titled correctly and if your spouse takes the right action within a specific window of time. The IRS does not send a letter explaining this. Your brokerage may not explain it clearly either. The concrete dollar example here is this. Suppose you leave a $400,000 IRA to your spouse instead of directly to your adult children. Your spouse rolls it into their own IRA. They delay distributions for several years. They convert portions to Roth each year while staying in the 12% bracket. Over time, they dramatically reduce the taxable portion of the account. If instead you had named your children as primary beneficiaries and skipped the spousal rollover option, those children would be forced to drain the account in 10 years, in a high-income decade of their careers, potentially paying taxes at the 32 or 37% rate on money you spent decades saving. The document that prevents this is the beneficiary designation form. It is not your will, it is not your trust. It is a separate form held by your IRA custodian, and it overrides everything else. That form determines who gets the account, and it determines what options they have. Here's what you need to do. Step 1. Pull your beneficiary designation forms today. Log into every retirement account you own. Look at the primary and contingent beneficiary fields. If your spouse is not listed correctly, call the custodian this week. Do not wait. A will cannot fix an incorrect beneficiary form. A trust cannot fix it either. The form controls the account, period. Step 2. Run a Roth conversion analysis. Look at your current tax bracket using line 15 of your most recent Form 1040. Calculate how much room remains before you hit the next bracket. Every dollar you convert today at 12% is a dollar your spouse will not pay 22% on later. You do not have to convert everything at once. Converting a manageable amount each year between ages 60 and 72 is often the most effective approach. Step 3. Understand the RMD age rules. Under the Secure 2.0 Act, required minimum distributions now begin at age 73 for most people. If you are approaching that age, you have a window to do Roth conversions before distributions are forced. Once RMDs begin, you cannot convert that required amount to Roth. You must take the distribution first and pay the tax. So the window is from retirement until age 73. Use it. Step 4. Review your Social Security filing strategy. The age at which you claim Social Security affects your spouse's survivor benefit. By law, your spouse can receive up to 100% of the benefit you were receiving at the time of your death. If you delay claiming Social Security until age 70, your benefit grows by 8% per year between age 67 and 70. That larger benefit becomes your spouse's survivor income for life. For a surviving spouse facing higher single-filer tax rates, receiving more income that was already taxed, rather than more IRA distributions that have never been taxed, can make a significant difference. Step 5. Request IRS Publication 590-A and 590-B. These are free documents available at irs.gov. Publication 590-A covers contributions to IRAs. Publication 590-B covers distributions. Together, they contain the rules governing inherited IRAs, required minimum distributions, and the rollover options available to a surviving spouse. Reading these documents gives you the legal framework you need to ask the right questions of anyone helping you with your finances. If you found this useful, subscribe. Every week I cover what the IRS expects from retirees, the rules most advisors never explain. The widow's tax is real, the inherited IRA rules are real, and the Roth conversion window is closing every year you wait. But now you know what most people never learn until it is too late. Share this video with your spouse. Watch it together. Because this information only helps if both of you know it.